that's when I really remember having like a fascination with real estate. I remember living in kind of the suburbs of Atlanta in a newish subdivision. It was the Publix anchored and Home Depot anchored shopping center getting built while we lived there, and like watching the construction process and really just remembering clearly not knowing the financial side and the investment side, just like, that's so cool. There was ground and now there's this whole shopping center, and like, how do I own that one?
Yo, what is up, everybody? Welcome to the Go Big Live Real Estate Investors Podcast. I'm your host, Matt Drouin. I have a very special guest I'm psyched out of my mind today to bring out of the show, Mr. Evan Pulaski of Axia Partners. Evan brings nearly 2 decades of experience in commercial real estate to Axia. Throughout his career, his primary focus has been on capital markets, orchestrating the acquisition of over $500 million in equity and another $500 million in debt. He has been involved in numerous private investment offerings, catering to a diverse spectrum of investors, ranging from accredited individuals to prominent institutional players. Evan's expertise extends across a wide array of asset classes. Personally, he maintains a stake as a limited partner in various private real estate ventures and is also a direct proprietor of residential rental properties. Evan holds a bachelor's degree in business administration with a focus in real estate from the University of Cincinnati. Wow, that was a mouthful, but welcome to the show, Evan.
Thank you. I appreciate you having me and looking forward to our conversation.
Yeah, no, I'm super excited to dive in later in the show. In terms of what we were talking in the green room about, was you kind of made a big jump from, doing some smaller, single family type of investments to the big leagues, but not as actual a lead sponsor, but as part of a team that's been involved in orchestrating, $1 billion worth of, private placement debt and equity. And so I'm really excited to talk about kind of the psychological jump that you did in your first investment property and how that parlays into what you're doing now. Yeah. So my first question, Evan, is you were born, now you're here. What happened in between?
Obviously a lot. Married, couple kids, have owned personally between our primary residence and some flips and some rentals, I think a couple dozen, maybe 30 houses in total. I've lost count at this point. The biggest thing, especially as it kind of pertains to this audience, is I remember being 5-6 years old in suburban Atlanta, moving down there with my family. That's when I really remember having like a fascination with real estate. I remember living in kind of the suburbs of Atlanta in a newish subdivision. It was the Publix anchored and Home Depot anchored shopping center getting built while we lived there, and like watching the construction process and really just remembering clearly not knowing the financial side and the investment side, just like, that's so cool. There was ground and now there's this whole shopping center, and like, how do I own that one day? So that kind of fascination really drove me into this career that it's become. And as you noted, with even studying real estate in undergrad, having several different corporate roles, a lot of that transaction volume kind of comes from, those corporate teams and being able to utilize all the different team members so that I could specialize in what I really enjoyed first and foremost, which was getting to talk to people about real estate. And then ultimately the investment side of real estate. It's been a fun journey. And look forward to continuing it for a long time to come.
So from daydreaming about real estate to doing your first deal, which was a single family property, what was the confluence of factors leading up to that decision?
Yeah, the biggest one, it was actually my first corporate job. So I was working for a retail operator that owns grocery-anchored shopping centers. And I was on their investor relations, capital raising type team as we were raising institutional money. But within that group, there were a couple of people that I was friends with owned these single families. One of whom he still does it, still friends with him. I think he's up to like 200 doors, almost entirely single families in Dayton, Ohio. But he started buying properties when he was in college, and his now wife was a part-time mortgage broker in 2005 and 6. I think that was the right era. But talking about how people were showing up to the bank, buying a house, and walking away with a $20,000 check. So that's what got him started. And so I was early in my career, but between my wife and I, started to save money and have some money available to start investing. And, ultimately it was him and another fellow that I was admittedly looking at college housing, thinking, okay, I live not too far from the University of Cincinnati. There's a lot of off-campus housing there. And they all told me, don't do it. you're going to get, just people ransacking the house. You're going to be turning it every year. It's going to be a heavy turn. They honestly convinced me to go into these foreclosures because it's 2010. And buy what I was ultimately running was a Section 8 portfolio of single family houses. Because the gentleman who wasn't in Dayton, the local guy who had maybe a dozen houses, he's like, they're all single mothers. The government pays a portion of it, depending on income levels. He's like, but they stay forever. And they're kind of lifelong renters. They know when to call you. They know when to just fix it themselves. He's like, it's so much easier. And so that was really kind of the big leap, was having not only the corporate and background, kind of in the finance and real estate side, sort of seeing how things operate, but in the single family space specifically, like two really good friends that I still, see periodically here as life has continued to go, that talked me into it, and just took the leap, and I guess I have looked back. I've sold a lot of them because I don't want to be a landlord as much as I had built myself up to directly, but generally never looked back, and financially has really helped explore other avenues of real estate as well.
One thing that I want to talk about, Evan, is that there's a lot of listeners out there that are in corporate jobs, that are, let's say, in corporate accounting or high finance. And my background as being a real estate agent and real estate broker is that you have very, very financially smart people. They can run financial models and all that sort of thing. But taking that and translating it into buying their first investment property or investing in real estate in general, and maybe you have some of these investment partners where it's part of your education process through Axia Partners, that it's like kind of difficult to get psychologically through that to something that's where the rubber hits the road. So how did you kind of like wrestle through that? It sounds like you needed some convincing to kind of make the jump on your own, because you had been touching this in your corporate job. So kind of walk me through kind of like that, like psychological journey of making that like transition into that first deal that started things for you.
For me, it wasn't so much the fear of actually doing it, because I kind of have the finance side, but I also have like the real world, I want more side. So like, there's a fear to taking action, especially when there's real money potentially to be lost behind it. I mean, very personally, I kind of felt like it wasn't a ton of convincing. I was seeing these other guys that were successful in it very firsthand before bigger pockets existed, before podcasts existed, as I know this was kind of 2009, 2010 era. So it's kind of all in who you knew. And so that certainly helped. I always like to quote a phrase, actually, from that first job. We had the chief financial officer and the chief development officer. So the company I worked for was primarily an acquisitions group, but they had a kind of development arm as well. And I don't know why I was in this meeting or in this office at the time, but I remember the chief development officer saying, to the CFO, "I'm a dream maker and you're a dream killer." So specific to your piece, you kind of have those personalities where you have the deal maker people who probably are a little naive in the numbers. And then you have the numbers people who typically tend to be much more conservative and will talk themselves out of every deal. And you kind of need to find that balance. But the biggest thing, and while I'm not a huge, like, oh, it's all mindset, just with the right mindset, you'll get it done. There is something to that. Like, I'm a firm believer, especially when you're talking big deals and in my role, raising money from outside investors, like there needs to be experience and you need to have lived through different things, but that's a whole other can of worms. But back to that first deal, if you're really kind of in that analysis paralysis, it comes back to, you can't be a perfectionist. The numbers are never going to be perfect. You're really guessing when you're underwriting a 200 unit, $20 million acquisition, a 400 unit, $100 million acquisition, or a $25,000 single family house that needs some renovation. You're guessing. And like, as COVID saw, as the last year and a half, interest rates saw, like unprecedented things will happen. And so you just kind of got to get through them. But as long as, in my take, it's always like, if you're close to 80% right, which is really a B minus, C plus type grade, you're probably going to get through just fine. It's if you're really sitting for that 100%, 99%, 98% certainty, you're never going to get it. And in that instance, that mentality, you just kind of got to say, whatever, I either want this or I don't want it. Back to some other roles, you gotta stop living the dream and either kind of take action or just say this isn't the right route for me. Corporate, 401k, ETFs. I mean, in 2023, the S&P 500 went up 23% or 24%. Like, that's not a bad return. And anybody that says it is lying to you. It's like there's nothing wrong with that either, if that's kind of the box that you best fit into and you're not looking to push outside that box.
Now, before you landed this first deal, like, how many properties did you look at before you landed on this one?
It was a much different era. So again, this was 2009. I was buying single families in Cincinnati, Ohio, where I live. So I want to say I only looked at like 6-ish before I offered on one. But again, I wish we could get back into this, and as I always say, the financial side of me wishes we could be back in that environment, because I was able to tour a house, 6 houses, pick which one I wanted to offer on, and I was only touring one a day. So clearly there was a week between when, I don't remember if it was the first one I toured. I don't think it was. But like, you'd go on, you'd sleep on it, you'd think about some more, you'd tour some others, and then go back to it and say, that one actually probably was in pretty good condition. I'm offer on that one. And you write your offer, and then you don't sleep for a night or two as the bank is, because in this case it was a foreclosure, the bank was reviewing it, and finally the agent I was working with, the listing agent that I was going the route of, these are cheap houses. This guy, if he has any pull, he's going to pull a little more for me if he's working me as the buyer and the listing agent. So I would just call the listing agent and tour with them if I could. And then it was just, just kind of hope and dream that I get it, and be scared that I hopefully did get it. But yeah, it was, like I said, it's a different time now. Honestly, when I'm touring houses with, what is that now, 15 years of experience in kind of renovation, single family work between flips and primary, full renovation type houses and the rentals. I do the flip stuff with my wife as a kind of part-time side gig, and we're down, mostly she'll tour the houses. She might tour 3 for every one that she offers, but she can, write off. She's looking at the MLS near daily. And, you just kind of learn with that experience of nope, too much, it's too high price. There's not enough room to move the needle kind of thing now. So it is a little different even in today's market.
So Evan, let me ask you about we were talking about the green room about this, is that you found out you made an offer, you got the house, and you were like, you had this like, oh crap moment. Walk me through that.
Toured the house. I didn't have a contract at the time. So we owned our own house. Like, my wife and I had bought one house, the one that we lived in, and it required a little bit of work. We got the home inspection. I had to get the furnace replaced. So I call my dad and say, who did you use when you do this? And he just gives me a name. And in hindsight, it was typical retail price. They have pretty vans. They show up clean. They pay for marketing kind of place. So you pay a premium. A friend of mine and I did the water heater ourselves. So this is a friend who had owned a couple houses, and he's like, I know how to do that. I'm going to need a second set of hands, but I'll help teach you. So have a bit of that handy side to it. So I say that because it gave me probably a slightly false sense of confidence, but at least some experience in, I've done small renovation stuff in the past. Some DIY stuff, some hiring some stuff out. So I could tour with a little bit of that knowledge. But then I saw this house, and just kind of looked it over because were all foreclosures, which the world has changed price wise, but this factor hasn't. It's like it was a cash offer, no inspection, no contingencies, no appraisal or anything. So like I had to just kind of see what I saw and hope that I was right. And, so having some of those experiences certainly helped. But yes, I remember like very distinctly, to give way too much detail, I was walking into an Aladdin's restaurant, which is a Greek restaurant that's kind of regional, I guess, near an IKEA, and stepped out. We were waiting for our table and stepped out because my realtor was calling me and he told me, and I was like, went back in with my wife. We didn't have kids yet. And was just like, I guess I'm buying a house. And obviously she knew I was doing that stuff, but it was stressful. And then she starts grilling me while this was kind of something I was doing with more so on my own. My wife wasn't terribly involved and she didn't really want to be at the time. It was still like, well, what about this? What about this? And like all throughout dinner. So it was kind of now I'm second guessing it even more. You didn't inspect the roof? No, I didn't. But that next day at work, didn't get a lot of real work done. It was talking with my friends that helped me get into it and trying to find a contractor. So like a woman in accounting, her husband was a handyman general contractor. A friend of mine that was in the leasing department, his uncle was a handyman, contractor. Is actually the one I ended up using for many years straight. And so it's just kind of having that group of people around me. I know I'm getting off the original topic. It was just scary. Like it's real money. Like I said, it was taking action, which is scary on its own, with real financial repercussions. Because like I'm actually writing a check, and in hindsight, it wasn't a huge check, but at the time, it felt like a really big check for where my wife and I were financially. And so it was just a matter of like, swallow hard and go with it and kind of trust your initial gut. And then obviously having that at the time in that office, there were about 150 other people, so I'm working in a moderate sized company. And like I said, most of my contractors for that first deal were ones I got bids from were references from people in my office. My first lender was the sister bank of my friend who got me into it, just because his lender was up in Dayton and they didn't do Cincinnati stuff. But they had a kind of a sister affiliate bank down here. I don't know. So it's just kind of having that network around me to lean on.
So you had like a bigger pockets forum like in your office then for all of your real estate investor needs.
It was, and it was interesting because again, this was a corporate job. While it was in real estate, you have a lot of people who were like even the leasing agents. They're out there selling space for leasing. The sales team in a real estate group, the commercial real estate group, and like I would talk to some of them. They're like, I don't own my own house. I'm still a renter. I don't this is just a job. I'm good at talking with people, connecting with people. So I figure it could be a lucrative job for me, or some of the finance guys. But again, you also have people more kind of like myself, my two buddies that sort of have this real love for real estate. And even though you were joking before about being in accounting, one of them was in the accounting group. Actually, both of them were in the accounting group in different kind of roles. But they were the ones that they were in the accounting group of a real estate company, but they're the ones that are actually investing in real estate at the same time. So again, it kind of worked out. And yeah, having that, I don't think it's unique to a real estate company, but when you are in an office and you've been there a couple of years, most of the people, or at least a lot of people around you, use them. They will have random experiences that will help you, or in this case, an uncle who's also a general contractor did good work for good price.
How did this experience translate into your job in raising capital nowadays? And how does it help you? Does it hurt you? Tell me about that.
It definitely helps. Since I'm in a capital raising role, I consider it a sales role. in all reality. And any sales is know, like, and trust. So over my years in this type of role, especially dealing with the typical accredited investor, the physician, the engineer, the accountant, the single family rental owner, it's helped tremendously because I can relate to that. A lot of passive investors are people who have owned anywhere from one to a few, maybe even a dozen. I don't know, you can really scale up as far as you want. Single family rentals, duplexes, four families, whatever that looks like, but it's kind of smaller real estate that they did on their own. And so you can just relate to them with some of the pain points of being a landlord. First house, although it was many years later, had a dead tree that I didn't even really recognize until a big limb fell on the fence between mine and my neighbor's house. And it was my neighbor's fence. And they call me up. And all of a sudden it's like, I got to take down this tree. Okay, that's a cost that I wasn't really expecting to overlook. But I remember having a conversation with an investor looking to move passively kind of through my day job. And somehow we're talking about, I was like, well, yeah, but even if you have a nice, whether it's a chain link fence or whether, especially if it's a wood fence, like that's going to deteriorate eventually. And that's going to cost money to replace. And this guy was kind of on the fence of investing. Like he had done some passive deals. He's like, I never really thought about that, but yeah, I've got a duplex with a fence I've got to replace. This could cost me $5,000. And like, I can afford it, but that really eats into the return when you're only netting, there's a while, so he's cash flowing pretty well, but especially modern day stuff, it's like most people don't factor that into their reserves. And if you're only cash flowing $150 a month out of a duplex, $300 a month, $150 a door, $300 a month, like that's $3,600 a year. That's a year and a half of free cash flow if you weren't already reserving for that fence. And all of a sudden it needs to be replaced, and it becomes an eyesore. Then you're getting lower rent. If you don't replace it, and it plays into that whole. So that was the long-winded answer. But I mean, again, a lot of the investors that I talk to, a lot of people out there in general, I think have owned a rental at one point or another. Even if it's just one, old house that they used to live in and they didn't sell when they bought their new house, and they started renting it out. So it has certainly helped in you have to write a bunch of stuff off. It's a little different when you're passive since you're not controlling the books and the expenses, but you still get that same kind of flow through. It's just on a K1 instead of doing your own books. And when you start talking about that, depending on how much pain they were in, like they either say, no, the return, the cut in returns isn't worth it, or a lot say, yeah, I'm sick of this, and I'm willing to take a little less money by letting somebody like a syndicator or a fund manager kind of do it for me, where I get most, if not all, the same general benefits without needing to control every aspect.
Yeah, I think the greatest source of lead flow that I've gotten actually from our investment partners as a company has been the typical reach out to you. Can I pick your brain? I see that you're in real estate investing and that sort of thing. Can I pick your brain? In the past, I've actually just kind of like brushed it off and I'm like, oh, well, I'll be at a meetup next month. Why don't you come and meet me there? But come to find out, a lot of these people that want to pick your brain as a operator and kind of learning the business, they have actually converted into some of our investment partners, because if you go through a proper discovery process with this potential investor, what they're going to do on their own or not, I think you can get down to the actual, through discovery and education, for instance. I think you can get down to the root that they really don't want to be a landlord. They want to have exposure to real estate. They understand that its benefits at a fundamental level. So that being said, in terms of switching gears here, like which kind of like your top of funnel through bottom of funnel process in your capital raising machine that you guys have built as a company in terms of how people in a cold audience turn into actual investment partners with Axia, and what you've learned in the past through Axia and also at Ashcroft.
Yeah, so it's shifted a little bit, especially with the current market and all the negative news that is around commercial real estate right now. So in the past, big lead source again was just general, or I shouldn't say lead source, an easier to convert lead source where people like you talk to. You go to meetups, you talk to them, you hear them vent about their single family ownership. It's too much work. As I used to joke, especially when I had, I think it was up to like 9 doors, so never a huge portfolio. Many months I wouldn't get a call. I'd just be cashing checks, recording them in QuickBooks. Insurance was on auto pay, real estate tax were on auto pay, mortgage on auto pay. So everything was just easy, and it was just money coming in the door. Inevitably, it felt like the minute I stepped into an airport to go on family vacation, first call would come. By the time I landed, I had 2 more voicemails from other tenants, just like, what is going on? And why do you always wait for me to be not around to have to do it? I don't know. And it feels like a lot of work because I'm kind of mentally checked out on vacation. Mm-hmm. So, and I've talked to many that feel that same way. So at the time, again, kind of dialing back, go back to, 2018, 19, 20, even 21, it was just a lot of people who were in pain with their direct real estate were ready to get out. And so that was kind of those days that still exists, obviously. Today, it's much more different. There's still people out there, but I haven't found those like kind of typical demographic where it's like, all right, I can get bigger pockets where I know a bunch of people who own real estate are or interested in real estate and easily convert them into investors because they're, on bigger pockets because they have pain in their current portfolio. Mm-hmm. Now you're playing a little bit more what I call mature investment game of diversification, potential and or realized returns, the track record. And I think a lot of potential LPs are getting wise just due to the news, potential or current LPs, with really diving into the debt structure. Like how are you structuring your deals? Because I'm reading about operator X in Real Deal that's getting foreclosed on because they bought floating rate loans. I'm reading about syndicator Y, who was, a career in IT with no experience, same idea, floating rate loans over leveraged. But he bought, a ton of, thousands of units across a couple years because capital was cheap. So now you're almost playing the marketing message, the educational content, the direct one-on-one conversations really come down to more like, how are we differentiated and how are we mitigating those risks? Where in the past, it was just whoever had the operating offer, the offering with the highest returns, typically won that investor if they were assessing 3 or 5 or 10. Now it's much more people, the LP base seems to be getting wise to where risks lie and are willing to accept a lower return to mitigate a lot of those risks while still hopefully having some upside of the deal.
How are you differentiating yourself in this environment? And then how are you mitigating the risks that are out there at Axia?
Yeah. So, structure is a big one. Debt structure, making sure we're going into, fixed rate loans truly, or floating rate loans that have, defined periods of fixed term and not buy a 2-year cap and hope and pray it's going to go away. And then you can always replace it with a really expensive cap. But kind of 3-5 year type, we're fixed here before we move into a variable rate. there's some unique financing structures out there as the lenders are trying to both mitigate their own risks while also be marketable to potential buyers. With Axia, one thing I love about them is they are diversified in terms of what type of products they use. As I kind of alluded to, my first job out of college was in grocery anchored shopping centers. That was where I started. Then I bought some single families. Then I worked for probably one of the largest apartment syndicators out there, or at least in the podcast world that people would likely know. So, really dove and focused into that multifamily space and loved it. It was great experience, great company. There's a lot of positives that come to it, but I've always had that bit of like, I'm real estate agnostic. I love real estate, but I love single families or flips and some rentals. I love multifamily. I love, with Axia, we do industrial and multifamily are our two focuses. Mm-hmm. And then we'll do some self-storage. We own a couple RV parks currently, but that's not a focus going forward because they're a little cumbersome to find and then ultimately sell because it's just a little bit out of the blue. But so I'd like that diversification side as well. Like I believe I can talk about because we're no longer raising for it, but the last fund we did raise as an industrial deal, 2 multifamily deals, and a self-storage deal. Mm-hmm. Geographically diverse. The industrial deal is ground up development, where the multifamily are acquired value add assets. So we're kind of building that different, one's all appreciation, hopefully will pay off, while we also have the cash flowing, typical value add play in the multifamily deals and self-storage deals. So again, sort of look at a different thing that really helps create in my opinion, a more secure, general investment vehicle for multiple reasons.
Evan, I consider you a raise master out there. Most of the people that are listening to this show they own a couple of single family houses. They maybe own a couple of duplexes. They're looking to swim upstream and do their first larger, like let's say $1 million to $2 million deal. They're not looking to do a syndication, but they're looking to position themselves to use OPM, whether that's through creative financing and promissory notes and all that stuff. What can they do like today, this month, to position themselves to have a successful raise on their first bigger deal?
I think a lot of it comes down to kind of sharing with the people that already know, like, and trust you. And so this probably is not unique information that anybody says share with you, but when I think about that first company that I worked for out of college, today, this has happened since I left, they are a publicly traded REIT. You can go buy their shares on the New York, maybe they're on NASDAQ, but either way, you can get on Robinhood and buy their shares. Uh-huh. When I was there, they were already, in 2007 is when I started there, they were already 15 years old. Mm-hmm. They were raising institutional money, which is why I was hired, and they were bringing that in-house. When they started, it was 2 partners, one of partner's dads, 2 of his friends, I think there were 5 investors in that first deal. Mm-hmm. Second deal, I think one of the friends fell off and 2 other friends came in. But it all comes down to these were guys who had experience in commercial real estate. One of them happened to have a dad who, had some money to put into it. I won't say he was uber wealthy, but, he had some money. And he had a couple other friends who had some money. You look back at other groups I've worked with or worked for, and you watch their same trajectory, and it tends to be very similar. It's, especially in today's market, it's hard for experienced operators, syndicators with, $500 million portfolios, multi-billion dollar portfolios to go out and raise money. Mm-hmm. You starting out with nothing, nothing in a relative sense in terms of using other people's money is going to be even harder. But when you're scaling from, let's say, 2 single families and a duplex, that's 4 units. It's not a big leap for people to make if they already know you, they like you, they trust you, to say, I'm going to buy this 10-unit property. nobody's going to come to you and be like, well, what experience do you have running a 10-unit property? You only own 4. Most people are like, yeah, that's a traditional, buy, just a little bit bigger. And so I know some people there, but multifamily groups in Cincinnati here, there's kind of 4 big families or entities that are buying most of the deals, not all of them, but a lot of those, the big deals. And a couple of them have not used outside money. One is a family, and they started as a property manager. They were managing other people's properties, and then they went and bought their own 10 unit. Then there was a value add 10 units. So they sold it, and then use that profit to buy a 20 unit. And the 20 unit scaled to a 50 unit. And they did it the slow and steady route. But after 40 years, they're worth well into the 9 figures. That's one way to do it. And then there's the other people's money. But like you said, it's kind of with a smaller raise, you can take smaller checks without overburdening yourself in terms of systems. It's not like you're raising, $100 million in $25,000 increments. And you need portals and everything else. It's like if you raise $1 million in $25,000 increments, that's 40 people.
Yeah.
So it's that. And the piece that I struggle with the most, kind of the direct feedback, is, again, kind of promoting yourself. It feels, at least for me personally, counterintuitive to be like, hey, I did this. Hey, we did this flip and we just doubled our money in 4 months. Mm-hmm. To me, it's kind of just, I do it, and that's that. But particularly in the capital raising world, it's kind of you got to toot your own horn a little bit in a tactful way, and let people know, yeah, I did this, and it was successful, because they're going to start saying, well, how can I get involved with that? Are you open to outside investors? And all of a sudden the money's chasing you versus you chasing the money. The last piece I'll add to it, because I've seen it, is, and this is kind of the next step, is kind of don't get greedy. The worst place to be in any syndicator's world is where it's you've been seeing successes, and so you just keep chasing the next one, and all of a sudden you've tapped out your investor network. Now you're having struggling raises. You're having to send out emails to your group saying final call, and then a month later you're second final call, and then a month later third final call, and also people are just what's going on? You coming from a real estate agent background, it's almost it's better to underprice about a house, in my opinion, and get a bidding war, and you'll probably actually end up at a higher rate than to be greedy on the front end, and then you just go with a stale listing. And people just assume it's sold because it's no longer showing up on their new listings kind of thing. They're going to take it off the market, do a price cut, get it back in front of people, and people are going to question it. So it's kind of just, find what you need to live off of. And anything above that is great. But I always take it, as I've considered being a GP myself, just sort of set your budget and don't get greedy beyond that. Let the carried interest get you beyond that versus trying to find more deals and raise more money, find more deals and raise more money.
I think that's great advice. The one thing is that I think that a lot of investors are looking to swim upstream into larger deals are kind of getting in their own head because they're hearing all the negative news out there associated with it. They're getting those emails from operators that are last call for a webinar this Wednesday, and they've gotten that's the 6th time they've gotten that email. They're oh my God, what's going on out there? And I think that they kind of allow that to throw shade on what they're looking to do, which might be to land their first $1 million, $2 million deal. And they may have to raise $300,000 to $500,000 to do that. And typically the best place to do that is from people that you already have the KLT factor with, the know, like, and trust factor with, the friends and family, the professional contacts. And I think that one of the things too is that when you're slowing down and being less busy, just doing larger deals incrementally, like you were talking about with that property management company, it's very easy to become oversubscribed on opportunities you present to your network. Because I have a client that they just locked up a 20 unit deal last night actually, and he's I think I got the investor lined up for it. I was well, just blast the opportunity, high level, couple paragraphs in an email, black and white, no graphics. You don't have to be fancy with that, and say, hey, we just got a property under contract. It's a 20 unit in this geographic area. Let me know if you'd be interested in learning more about it once I make heads or tails of the deal, and that sort of thing. It's like, well, I think I already have the investor. Why would I blast it out? It's like, you want to be communicating to your network that you're active. And even if and the best thing to say is like, hey, Ryan, what's going on with that deal? I'd love to hear more about it. Oh, you know what? We actually, we raised the capital in a day. It's better to be that than having to, chase after that, because people can smell commission breath, so to speak.
Yeah, no, agreed. It's, and while this is where the finance side comes out of me, and I respect the marketing and like deal making side as well, but I never want an investor who is like desperate, but I also understand from like the deal making side, the syndicator side, why it's like you want all your investors to be desperate. So I've heard stories, and I guess it has happened to me, where we've turned down investors or turned away. Like, actually, I've had some commitments where it's like, we're too far oversubscribed. Like, we got to cancel your commitment. But the moral of the story is, it's like, yeah, if you can fill a deal in 24 hours, whether it's $200,000 or whether it's 200 million, the excessive amount, but still, there's probably some groups that have done that. It's like, you're going to just create that sense of urgency on the next deal. And that sense of urgency is like powerful. When you tell somebody, sorry, you missed out on that deal, and ideally say, but we're actually talking with somebody, we should probably have another one in another week or two, whatever it is, a week, 2 month, because you want to make sure, you want to hopefully prime people to maintain some liquidity for a short amount of time so they can jump right into that next deal. But when you lose that sense of urgency and, like you said, kind of commission breath, just like desperation, it doesn't only slow down the raise and give you internal stress. It's like people start to question, like, well, what's wrong with this deal? Maybe nothing's wrong. Just your network is not as big as you thought it was. It's still a great deal. But like when it's out there, like I said, stale listings on single families all the way up to syndications, like that time makes people, time kills all deals. And it makes people really question, like, why aren't you filling this one up? There's something wrong with this deal. Now I'm second guessing. I'm going to really dive hard into your numbers and all of your assumptions, whatever that looks like. So again, there is that fine balance. And I never want an investor who gets into a deal not knowing what they got into, just out of desperation, like, you sent me another deal, I need to get into it and let's go. And then that's the deal that goes sideways because they're hit to tell a lot of people. But you've got to kind of straddle that balance.
So last question before I definitely want our listeners to find out how to learn more about Axia. But last question is, your finger is on the pulse of the market in terms of capital raising for deals. You're talking to other sponsors that are out there. Like, what's going on currently, like right now as we speak, in the capital raising space, the capital markets, commercial real estate, all that good stuff?
Yeah, I mean, it's just a challenging market in reality. I just got somehow through LinkedIn, somebody I followed commented or something about somebody else. There's an entire account. I couldn't tell you what this guy's name was, but I clicked through to his account. He is simply sharing foreclosures. And not all, like hotels, office, apartments, but like every day or multiple times a day from different news outlets. Oh, here's another deal that's going into foreclosure. Here's another deal that's going into foreclosure. So anybody in this space, especially if you only got into it in even the last 10 years, in reality, like post financial crisis, like it feels like a seismic shift. Real estate is out of vogue in all reality. Just like Bitcoin, like on Instagram, I get far fewer of the real estate gurus selling their course advertisements and the Bitcoin, guys doing the same thing. For those that are really truly, like, this is my career, they're going to get through it. And you just have to be patient. I consult with a group out of North Carolina, and they've been getting deals from their brokers. Some are kind of pseudo off market, where the broker contacted the owner and he said, I'll sell it if you can get this price, but like, I'm not giving you information to put together a marketing package or anything like that. To full on market. And actually, I was talking with them yesterday, a couple of days ago, and there's a deal that was helping them underwrite, and I'm like, this one actually like makes sense. And I confirmed with them what the price opinion was, or like the broker's kind of direction is, and I was like, are you sure? Like is that accurate? Like, they really think they're going to sell it for that, in the sense of like, it was a realistic price. The numbers made sense. It was a 6.3 cap going in not a terrible area, on a 224 unit property. The one prior to that, actually the 4 prior to that, were like, these guys are insane. Like, you want to sell us a 5 cap for a Class C property in a Class D area that, like, borrowings rate, where they're getting quotes anywhere from 6.5 to 9.5, depending on floating, fixed, recourse, non-recourse, other stuff. I was like, that's negative leverage. That's real estate 101. You buy at a higher going in cap rate than you borrow at. If you do that, you're going to be fine. It's where everybody is underwater right now. They bought at a 3 cap. Their current financing costs them 5 cap, or 5% interest, 6% interest, whatever it is. It's like, you're underwater. You're bleeding cash every single month. So that's the long answer. Again, it's kind of got to be patient. The market, I think, is going to start resetting. As noted, I saw the first deal ever that like actually was penciling to, like, you could pay the actual price that they're quoting. You could probably pay more, but it's stay in front of your investor network, because just, you're not active, but you have to keep them interested. Syndication is marketing, syndication, capital raising, whatever. Like, you are a marketer, really is your primary role when you're out raising. So it's like, you just gotta, hey, here's a deal you're not in. Here's how our portfolio is performing. I personally, knowing the market, don't like the general market report kind of stuff. I know that's valuable to some people, especially as they're newer to it. But really, it's like, the operators who are going to survive this downturn are the ones who are continuing to grow NOI, especially if they're the value add like space. They're going to keep growing NOI. And they're not going to have new deals. So you kind of need to highlight all those little things. What are you sharing with the current investors that could be counted as a win? Don't hide the risks or things that are going wrong necessarily, but obviously you don't want to point them out. And yeah, just kind of be patient and wait, because I think we will get back to the more traditional fundamentals here in this time next year. I think we're getting 2 more rate hikes this year. So I think that's going to put some blood in the water with a lot of people, and you're going to start seeing deals trading at 6 and 7 and 8 caps, but decent deals, not the war zone deals.
Yeah. And
once those start hitting, then, a lot of buyers are going to be wiped out because they realize their deals aren't worth anything. And you're going to have those that survived come in, and those new people are actually probably going to be at an advantage at that. Maybe not the people who survived, but like all the people that got wiped out that are struggling, had to sell for losses. They're going to be struggling. Like, you're almost better to be coming in today, a year from now, or over the next year, than being that group that's struggling for, a legacy operator that's selling big deals out of losses and wiping out a lot of their. That was the long-winded thoughts on the market.
Evan, we're going to wrap up the show in a little bit here. So is Axia doing any raises currently for anything?
Check our website and be on the lookout. We definitely have some opportunities in the hopper that I'd love to talk to people about, but as of right now, we're also a 506B operator. So, so we don't have anything and legitimately, I don't have anything I'm actively raising for right now anyways, but I always tell people they can check axiapartners.com, follow us on Instagram, which is Axia Partners as well. Connect with me directly at Evan, EVAN, and Axia Partners. Lots of different ways to connect, and always happy to talk, as you noted, whether it's direct about Axia or the thing I love most about my career in investor relations, and particularly when I'm dealing with more individual versus institutional investors. I'm an individual investor too. Like, we just talk, share war stories about landlording, share wins on our passive investments or flips. Like talking to people about real estate and have for a long time. So never hesitate to reach out.
Excellent. So yeah, you got deals in the hopper, but it's classified. So
classified currently, but again, we're actively looking at different deals, no current offerings, and always happy to chat with you. Well, the last thing I'll kind of note to that is I enjoy talking with, from the day job, while we are 506B, we only accept accredited investors. We try not to test the waters with the sophisticated investor allocation that we legally are allowed to. I don't know why I put legally in air quotes. That is true. But I like, unaccredited investors too. I'm always, like I said, there's information I'm happy to share, since, as you noted in my bio, like I started in commercial real estate, and first job out of college was capital raising with institutional funds, which really helped me get the higher level of knowledge. And I don't want to say I dumb it down for like the standard individual investor, but it's like the standard individual investor doesn't want to know about cash flow statements typically and how that flows through the balance sheets and P&Ls, or, domestically controlled REITs. But I'm happy to share that. But like I said, I also know that I've, thankfully been able to transition myself from a, unaccredited investor with one rental, and primarily through those rentals, and sometime was able to move into that accredited investor standpoint. So kind of remember some of those feelings, ways to find other operators, et cetera, that might take a sophisticated investor and not just accredited investors. So like I said, always reach out. I never turned down a chance to meet somebody new.
Excellent. Evan, thanks for being on the show today. If you're listening to this right now or watching this right now on YouTube, and you want to get in on exclusive educational content that we drop on our YouTube channel, definitely check out my handle on YouTube is Matt M. Drouin. That's MattMDrouin. Make sure to hit the subscribe button and the notification button. I drop long form educational content for real estate investors that are looking to scale into larger real estate deals, as well as when we release these podcast episodes too. So make sure to do that. Evan, thanks again for being on the show, and we'll be in touch.
Thank you for having me, Matt. It was a great time.